we are discussing, analyzing the intricacy of taxation of income from petroleum operations under the proposed Nigerian Tax Bill 2024.
As you will know, not all of us have very much to do with petroleum tax. So a lot of people skip over the full details there.
The Chartered Institute of Taxation of Nigeria, CITN, is the only body statutorily empowered by law to regulate the taxation profession in Nigeria. In doing this, the CITN sets standards of educational preparation, training and retraining necessary for the empowerment of persons desirous of practicing taxation as a profession. Again, in doing this, from time to time, the CITN organizes MPTP, workshops, conferences, and as time has dictated as in the age of technology, webinars. On Tuesday, the 18th of February 2025, the Institute hosted a webinar on Analyzing the Intricacy of Taxation of Income from Petroleum Operation under the Nigeria Tax Bill 2024. For more than 60 years, oil, crude petroleum, has been the mainstay of the Nigerian economy. Expectedly, a major chunk of tax revenue has come from that all-important sector. Oil and gas is a highly technical field that requires deliberate, intensive training and retraining of men and women deployed into departments or departments responsible for petroleum tax. This outing of tax matters is on analyzing the intricacy of taxation of income from petroleum operation under the Nigeria Tax Bill 2024.
It is very important that I give a preview of today's topic. The bill in question is in Chapter 3 of the Nigerian Tax Bill, and during my research, I realized that the section of that bill contains 53 sections, which our lead presenter will be doing justice to, and it contains also 4 parts. It means there's a lot of issues in the taxation of income from petroleum operation to have almost 54 to 55 sections, which our paper presenter will be dealing with.
The bill is introducing a hydrocarbon tax, which is levied on revenues generated from crude oil production. It's changing some of the deductions under the allowable deductions. There's consolidation of the laws into a single simplified law, and that includes the repeal of the PPTA, the Petroleum Profits Tax, and integration of its provisions into the new tax framework. That in itself is a Herculean task. And of course, revenue collection now specifically tasks the Nigerian Revenue Service with responsibility for all of the collections. It's going to have a massive impact on the petroleum industry. Companies and those of us who advise companies are going to need to adapt to the new structure and ensure compliance with the updated regulations. And this may involve going right back and revisiting your entire financial strategies and accounting practices. And Alhaji Aziz will bring out some of these in the excellent examples he has to walk through with us in this, as Dr. Ade said, a very technical session.
The expectation is that at the end of this session, the participants are expected to broaden, their horizon on general overview of taxation of income from petroleum operations under the Nigerian Tax Bill. So today we are going to be focusing on Chapter 3 of the Nigerian Tax Bill. Chapter 3 actually has 4 parts, and we will be looking, at part 1. Of those 4 parts, which has to do with the hydrocarbon tax. Part 2 has to do with the petroleum profit tax, because there is still grandfathering, for those who are still under the PPTA or Petroleum Profit Tax Act. That has been technically abolished, but however, is still on because of fiscal stabilization. So it's still there. So we look at chapter 3 as well, deal with the deep offshore inland basin production sharing contracts. Then we'll be looking at the miscellaneous, sections where you have the definition of some terminologies, which is the part 4 of chapter 3. The third thing we will be looking at is the importance of tax audit, in oil and gas industry, as well as its administration. The focus today is really for us to understand chapter 3 of the Nigerian tax bill. As of this morning, I'm aware that this bill has already passed, the second stage, and is now at the committee level. So I believe we will all have, opportunities for, public hearing in respect of this. The Economic Stabilization Bill 2024, introduced as part of Nigerians' broader fiscal reforms, aim to address revenue challenges and then stabilize the economy amidst fluctuating, global oil prices. A key component of the bill is the adjustment of the tax structures for petroleum operations to align, with the Petroleum Industry Act, PIA 2021. So on one hand, what we were having from 1959 to 2021 was only one tax, which is petroleum profit tax under the Petroleum Profit Tax Act. And then now what we are having going forward is hydrocarbon tax plus the company's income tax. The provisions governing the ascertainment of chargeable profit and chargeable tax under the hydrocarbon tax are found, in section 260 and 275 of the PIA, which is the existing PIA, which is now section 65, starting from section 65 of the Nigerian tax bill. So whatever you find in section 260 to 275, you will find it in section 65, of the of the Nigerian tax bill to section 88. So that's what you will find there. But it actually runs to section 118, to cover both the PPTA as well as the deep offshore inland basin production sharing contract, as well as the miscellaneous, provisions. So it is good to place this on record.
As this has rightly said, there are a lot of grandfathering provisions for PPT and the hydrocarbon tax under Chapter 4 of the PIA, and then the Deep Offshore and Inland Basin Production Sharing Contract Act. However, there are one or two areas I would like to shed more light with respect to the intentions of the bill from our own perspective. From our own perspective is we just want to simplify the entire tax processes. But whether this particular document simplifies it is left for the petitioners to decide, and as we move on, because from the onset of the PIA and the PPTA at tax authorities level is a bit complex and a bit difficult for us, because we just have to know the old PPT very well and also know hydrocarbon tax and Deep Offshore and Inland Basin Production Sharing Contract Act. Now, having said that, there are some areas I would like to come in under that Chapter 3, because beside those Chapter 3s, there are schedules that are tied to that Chapter 3s, right? So, for instance, we have the first schedule that has to deal with capital allowance. You have Part 1 of that schedule, or the first schedule. You have Part 2, and you have Part 3. And then we have the 6th schedule that deals with production allowance, cost price ratio. And then the 7th schedule, particularly, which I want to speak to, is also tied to that Part 3, Chapter 3 of the Nigerian tax bill. So there are relevant schedules tied to that chapter. But before even speaking to the schedule, let me start with the cost consolidation, right? The concept of the cost consolidation is only on terrain basis with respect to the income tax computation of the dual tax. So it's not on terrain basis for hydrocarbon tax. So hydrocarbon tax consolidation is in line with the rate for that particular OMN, not on terrain. So if you are in onshore, and then you have a PML that is 15%, and then you have, a PML that is 30%, and you have a PPL that is 15%, you cannot consolidate even though you are in onshore because the rates are different. Yeah. However, if you have a PML of 30%, PPL of 15%, you can consolidate the SITA irrespective of the terrain because the rate is the same 30%. So we just need to get that rate. So the consolidation is not strictly on terrain basis. It's tied to the rates. So for SITA is a common base. So if you go to section 70, I think it's section 76 of that Nigerian tax bill, you'll see where the issue of cost consolidation was being discussed. The first paragraph of that was dealing with income tax, for which I'm still going to add to it because this presentation did not, to some extent, speak much about the income tax aspect of the dual tax regime, and I understand the time limit, right? So the income tax is the area to which we consolidate because the bases are the same, but for the hydrocarbon tax, because you have two rates, and the rates are tied to different licenses that you hold, you can only consolidate along the rate that you have. And then another good thing that the bill has also tried to do is the fact that if you go to section 264 of the Petroleum Industry Act, right? Recall as Mr. Aziz rightly said, the whole of chapter 4 of the PIA has not been repealed, but it was deleted and taken to the Nigerian tax bill, right? Now, if you go to section 264 of that particular section, the royalty there was royalty incurred and paid before it can be allowed for tax purposes, right? But in practice, we have come to understand that, look, companies are not practicing a cash basis, right? So it's difficult for you to insist on royalty incurred and paid. So what this NTB has done is to take away that word paid. So royalty incurred now is an allowable deduction under the NTB, right? And then again, the other one is on the issue of the capital allowance I just needed to add. Yes, the capital allowance now is 20% on a straight line for 5 years. But you're going to keep 1%. That 1% is not going to reduce or increase the value of your qualifying capital expenditure. It's just going to be for statistical purposes. Unlike before now, the fifth year was supposed to be 19%, and then you keep that 1% that was supposed to impact on your capital allowance. So under the new law here, you take your 20%, but you need to put an historical 1% of the value in your book, right? It's not going to reduce or increase or impact on the value of your QC. So we have to note that as one of the changes that the law has also bring on board. Then the other one I needed to add was on the case of production allowance. And to me, if my own personal opinion, I think allowances should be simplified. Determination of allowances should be as simple as straight line of 20% annual allowance of applying a percentage to the value, right? So the only input I want to make around the production allowance is the fact that the production allowance for existing license holders, we have to note this because it's very important. For existing license holder, the production allowance is on lease basis. It is only for new entrants, and new entrants are those that got their license after the passage of the Petroleum Industry Act. If you get your license after the passage of the Petroleum Industry Act, your production allowance is on field by field basis. That's the difference. So for existing guys that converted is on lease basis. And then for the new entrant guys is on field by field basis. Another point to note is that production allowance is not applicable to companies under the deep offshore, under the PIA. Yeah. It's just strictly for companies onshore and shallow water and their hydrocarbon factories. So that is what we have for production allowance. And then there's also frontier acreages that is yet to be classified. So the rate can either be 15% or 30%, pending when it is being classified, right? Again, the royalty aspect of it, I would like to also speak briefly because it's one of the area of strong contention. If you go to the 7th schedule, I think it's in the 7th schedule of this new law, because FRS will now be administering the royalty. So we have royalty by production and royalty by price. So one of the changes you could notice, particularly on royalty by price, is the fact that in 2019, when we have the deep offshore and inland basin production sharing contract amendments, that amendment introduced royalty by price to start from above $20, right? So that windfall royalty will kick off. However, during the PIA, that was further increased to from $50 and above. Above $50, you have royalty by price. So what we have now in the Nigerian tax bill is to turn it back to royalty by price, kicking in from above $20, right? So those are some of the few changes. And again, if you also listen to the presentation from Alhaji Aziz, you notice that issues around administration was not mentioned here because that would impact in another bill completely. Issue around filing, the penalties on filing, and the need for you to plan your tax. And I would like to also add this, that FRS, we're not too scared of tax planning per se, right? And I like his last comment towards his concluding part. We're only mindful of the fact that there's a thin blue line between aggressive tax planning and tax evasion. It's a very thin line between of them, even though they said one is legal and the other one is illegal. We're mindful of the fact that there's a level of aggressive tax planning you will go into, you're already in the realm of tax evasion.
Yeah.
Right. And so that's just what we're mindful, but we're not scared of tax planning. As a matter of fact, part of our policy is to encourage voluntary compliance and also educate the taxpayer on how to pay their tax properly and rightly.